If you want to know if the economy is actually, heading for a crash, don't look at some massive government GDP report.
Oh, absolutely not.
Right. Like, look at how many everyday mid-sized businesses are suddenly overdrawing their checking accounts on a random Tuesday. Today, we have the ultimate blueprint for doing exactly that.
It's the absolute ground truth. I mean, the giant national headlines, they almost never capture this specific, nuanced financial pressure points that regular people and local businesses are feeling day to day.
Yeah, exactly.
We always crave this simple metric to tell us if the economy is broken or not, but the reality on the ground requires a much closer look.
And that is our mission for today's deep dive. So, welcome in, everyone. It is Friday, April 17th, 2026. And to see what is really happening beneath the macroeconomic surface, we are looking at a fresh, highly detailed first quarter 2026 earnings presentation from Regions Bank, which was just released today.
I know that a bank's quarterly earnings deck might sound, well, a bit dry on the
Even
surface.
a little bit.
Yeah, but it is actually one of the most powerful unfiltered lenses we have available. A bank's balance sheet is this direct mathematical mirror reflecting the actual financial behaviors of millions of businesses and consumers right now.
So whether you are managing your own business or, keeping a close eye on your personal savings or just trying to understand where the economy is actually heading, this document reveals the mechanics behind the headlines. Okay, let's unpack this.
Let's do it.
The overarching theme Regions is claiming right at the top of this presentation is that they are generating consistent, sustainable, long-term performance with top quartile returns among their peers. But I want to see the proof. What story did the numbers actually tell?
Well, the top-line figures show a highly profitable quarter. For Q1 of 2026, Regions generated just under $1.9 billion in total revenue.
Wow, okay.
And from that, they're reporting roughly $539 million in net income available to common shareholders. That translates to about 62 cents in diluted earnings per share.
Let's translate that last metric for the listener real quick. Diluted earnings per share basically means if the bank took that roughly $540 million in profit and divided it up evenly among every single share of stock that currently exists.
Including stock options that haven't even been exercised yet.
Right, including those, each share would theoretically be entitled to 62 cents of that profit for this 3-month period alone.
Precisely. It just gives you a standardized way to view profitability, regardless of the company's total size. And, speaking of standardization, they are running an efficiency ratio of about 56.6%.
Which means what exactly in practical terms, like for the listener?
Simply put, it costs them roughly 56 cents to generate a dollar of revenue.
Oh, I see.
Yeah, and the lower that percentage goes, the leaner and more efficient the operation is. For a regional bank of this size, keeping that number in the mid-50s is the mark of a very tightly run ship.
Okay, that makes sense.
They also posted a return on average tangible common equity of 18.26%, meaning for every dollar of physical tangible equity the shareholders actually own, the bank is generating an 18-cent return on it annually.
That sounds like a really well-oiled machine on the surface. But if we want to understand how that machine is fueled, we have to look at what banks call net interest income, or NII.
Yes, this is the absolute core of the traditional banking model. For Q1, their NII came in at $1.261 billion.
Okay.
And alongside that, their net interest margin, the NIM, dropped slightly by 3 basis points to 3.67%.
Let's pause there, because a basis point is just banking jargon for 1/100th of a percentage point. So a 3 basis point drop is just like 0.03%.
Right.
But wait, we are living in a high interest rate environment right now. So what does this all mean?
Yeah.
NII is basically the bank's bread and butter, the markup between what they pay you for your deposits and what they charge for a loan, right?
Exactly.
But wait, if rates are high, shouldn't their NII be going up, not down?
What's fascinating here is that the logical assumption is exactly what you just said. But if you look under the hood, the mechanics behind that slight 2.6% NII decline reveal a lot. First, the first quarter literally had 2 fewer days in it than the fourth quarter.
Wait, really? 2 days makes that big of a difference?
Oh, yeah. When a bank generates interest daily on billions of dollars, 2 fewer days mathematically strips millions out of the revenue line.
Wow. That really puts the sheer scale of a bank's balance sheet into perspective. Millions of dollars just from the calendar.
It really does. And on top of that calendar quirk, there were a few non-recurring items from Q4 that obviously didn't repeat, things like a specific $10 million seasonal HR asset dividend and $7 million in credit recoveries.
Oh, okay.
But The most strategic reason for their profit margin tightening, this loan spread compression, is how they are actively managing their loan portfolio. They are deliberately shifting their lending toward highly rated corporate credits.
Which means they are lending to safer, more reliable borrowers.
Yeah.
But the natural trade-off for that safety is that you can't demand as high of an interest rate from a perfectly safe borrower. So the profit spread on those specific loans is just a little tighter.
Exactly. It's a highly calculated decision. They are sacrificing a tiny bit of margin today to drastically lower their default risk tomorrow. And despite that slight squeeze in the first quarter, their outlook remains remarkably bullish. Regions is projecting a 2.5 to 4% growth in their full year 2026 net interest income.
That is a confident projection. If they are intentionally taking on lower yield, safer loans, what macroeconomic weather are they counting on to hit that target?
Well, they're relying on the assumption of a mostly stable yield curve for the rest of the year. They expect the 10-year Treasury rate to hang between 4.00 and 4.40%. If that environment holds, their older fixed-rate assets that are maturing will turn over and reprice at these newer, higher rates, which provides the actual mathematical fuel for that NII growth.
So they are actively accepting slightly tighter profit margins on these loans to prioritize safety. But to even generate that net interest income in the first place, a bank needs fuel, right? Loans and deposits.
Yep, the engine of the bank.
Which brings us to our Main Street barometer. Who is actually borrowing this money and who is saving it? Let's start with the borrowers. Average loans grew by 1%, and the ending loan balances for the quarter increased by 2%.
And it is vital to look at where that growth is concentrated. The presentation highlights broad-based commercial and industrial lending, often called C&I.
Okay, so what does that look like in the real world?
We're talking about power and utilities, manufacturing, healthcare, and asset-based lending. This is the physical infrastructure of the economy expanding.
So it's not like speculative startups burning through venture capital, but even within those physical sectors, lending is inherently risky. What safeguards are they putting in place?
There is a crucial nuance in their origination data that answers that exactly. It shows calculated, conservative growth. 80% of these new loan originations are going to their existing clients.
Wait, 80%? That is incredibly concentrated. Instead of chasing brand new business, they are just extending larger lines of credit to companies they already have deep financial visibility into.
Yes. They already know the management teams. They monitor the cash flows directly through their own systems, and nearly two-thirds of those loans are classified as investment-grade credits. It's not reckless lending. It's supporting proven winners to expand, rather than taking blind swings to artificially juice their loan growth numbers.
So if that is where the capital is flowing, we need to look at the supply side. Let's shift to deposits. The bank noted a modest increase in average deposits, with ending balances ticking up 1% to hit roughly $131.9 billion.
Right, and that specific 1% growth is largely tied to normal seasonal patterns. First quarter tax refunds hit people's accounts, which artificially inflates balances right before tax payments go out the door.
Here's where it gets really interesting, though. Even with that deposit base growing to almost $132 billion, their overall deposit costs actually declined by 13 basis points quarter over quarter. How is a bank lowering what it pays for deposits while still growing its deposit base in 2026?
It comes down to a deliberate mix shift happening across their customer base. Customers aren't just sitting in static accounts. They are actively moving capital away from certificates of deposit CDs and shifting it into money market accounts.
So depositors want a little more liquidity. They want the ability to access their cash without the penalty of a locked-up CD, even if they have to accept a slightly lower interest rate for that privilege.
Precisely. And perhaps the biggest advantage the bank has is its stable mix of non-interest-bearing deposits. Right now, those accounts represent the low 30% range of their entire deposit base.
Let me make sure I am grasping the scale of that. You are saying roughly 30% of their total deposits pay zero interest whatsoever. Why would anyone leave their money in an account yielding nothing right now?
Because of the operational reality of running a business. Think about a mid-sized manufacturer, right? They maintain checking accounts to hold payroll, receive incoming vendor payments, and manage daily operating cash flow.
Oh, I see.
Yeah, they aren't transferring that money into a savings account every night to chase a 4% yield. They need it completely liquid and accessible to run their operations. That dynamic provides the bank with a massive, highly stable, and mathematically free funding base.
Which leads to a metric the report highlights, which is an interest-bearing deposit beta of 35% for the cycle. Let me translate this deposit beta concept because it is crucial.
Go for it.
If the Federal Reserve raises interest rates by a full 1%, a 35% deposit beta means the bank only has to raise the interest they pay out to their depositors by about a third of a percent to keep them from leaving for a competitor. The bank gets to pocket the difference.
That is the exact mechanism. They have a strong, sticky deposit franchise. It proves that businesses value the operational relationship and the software ecosystem the bank provides, not just the raw interest yield.
If a bank is only passing along a fraction of rate hikes to its depositors, that beautifully covers their lending margins. But after looking at loans and deposits, the core engine of a bank can't just rely on lending to stay highly profitable. Which brings us to the operational side, the side hustles and tightening the belt.
Exactly. When we talk about side hustles, we are looking at how the bank makes money without lending, which is non-interest income, or NIR. This came in at roughly $625 million for the quarter.
And that's down about 2% from Q4, right?
It is, but you have to break down the individual components to see the real story. There are distinct winners and losers within that number.
Right, because card and ATM fees dropped 5%. But the presentation clarifies that is just normal seasonality. People simply swipe their credit cards less in February than they do during the December holidays. Mortgage income was also down.
Yep.
But then you look at capital markets, which increased 3.8% to hit $83 million. And the absolute standout metric, Treasury management hit record fees, up 6% linked quarter.
Treasury management being a major growth driver is a profound signal about the broader economy. This isn't lending. This is the bank providing complex operational support to corporations.
Like automating payables and running cash flow forecasting.
Exactly. Real-time fraud prevention, automating receivables. The fact that this specific category is hitting all-time record highs proves that business clients are leaning heavily on the bank to make their own internal operations more efficient.
So they aren't just a lender, they act as the outsourced financial IT department for these businesses.
That is the perfect way to frame it. And on the capital markets side, they expect revenues to consistently hover in the $90 to $105 million range going forward. It highlights a very sustainable fee generation engine.
Now let's look at how much it costs to keep the lights on. Expense management, labeled as non-interest expense, or NIE. For Q1, it came in at $1.068 billion, which is actually down 3% on a reported basis compared to the prior quarter.
Managing over $1 billion in quarterly overhead while inflation is still impacting the broader economy requires immense discipline.
It reminds me of trying to manage a household budget where inflation is hitting your grocery bill hard, but you've managed to cut your utility costs to balance it out. But I have to push back on one detail here.
Okay.
The first quarter is notoriously brutal for corporate expenses. You have payroll taxes resetting, 401k matches hitting, and annual merit increases taking effect. If overhead dropped 3%, where did they actually find the cuts to offset all that?
It was a very careful balancing act.
Yeah.
The unavoidable seasonal increases in payroll taxes and merit raises were essentially neutralized by lower overall incentive payouts across the company.
Lower bonuses, essentially.
Right. Additionally, there were specific fourth-quarter employee benefit liability impacts that didn't repeat in Q1, which acted as a natural mathematical counterbalance.
But they didn't escape completely unscathed on the regulatory side. I see a sudden jump in FDIC insurance assessments, up $16 million.
Yes, but this highlights an important lesson in reading quarter-over-quarter financial comparisons. That $16 million jump isn't like a penalty for doing something wrong today.
So what is it?
Well, in the fourth quarter, the bank recorded a special assessment reduction that artificially lowered their expense for that specific period. Because that reduction didn't repeat in Q1, returning to the normal baseline mathematically looks like a sudden spike on paper.
So it's just the math returning to its baseline. And the key takeaway here is that despite all these moving parts, the bank is officially projecting positive operating leverage for the year, meaning they fully expect their revenue growth to outpace their expense growth.
Which is the fundamental goal of any management team.
Okay, so a bank doing well today is great. They are managing costs, keeping corporate clients sticky, and lending safely. But what happens if the economy turns sour tomorrow? Let's move into doomsday prep asset quality, capital, and the regulatory horizon.
It is the most critical question you can ask of a financial institution. And the data regarding their credit health is surprisingly positive.
Yeah, net charge-offs, which are the bad loans the bank has officially given up on collecting and written off entirely, actually decreased by 5 basis points down to 0.54%. And non-performing loans, which are the ones currently in trouble, dipped down to 0.71%.
And because of this improved asset quality, the actual defaults decreasing, and because they saw internal risk rating upgrades within their existing loan portfolio, the bank was legally able to reduce its allowance for credit losses.
The ACL, that is the mandatory rainy day fund banks have to keep locked away to cover bad loans.
Correct. They actually reduced that reserve by $39 million, bringing the total emergency fund down to $1.647 billion.
To put that in perspective, this is basically like a retail store's shrinkage budget. If you budget for $10,000 of shoplifting for the year, but you install better security cameras and only end up losing $5,000, you get to put that difference back onto your balance sheet. The bank is legally allowed to hold slightly less emergency cash because the mathematical risk of their loan portfolio got safer.
That is an excellent mechanical comparison.
But if the bank is so confident they're reducing their emergency reserves, what does their overall safety net look like to protect depositors like our listeners?
The broader safety metrics are massive. First, look at their total liquidity sources. This is the pure cash and immediately available borrowing capacity. It sits at $67.9 billion.
And their liquidity compared to uninsured deposits.
It is a staggering ratio of roughly 178%.
Meaning, if every single person in business who had deposits over the FDIC insured limit walked into the bank tomorrow and demanded their cash all at once, the bank has nearly double the liquidity required to pay them out instantly.
Right. They are so well capitalized that they are aggressively returning value to shareholders. In Q1 alone, they declared $227 million in common dividends and executed $401 million in share repurchases. A management team does not buy back $400 million of their own stock if they have any underlying concerns about institutional survival.
No, they definitely do not. But there is one potential regulatory curveball mentioned in the presentation: the Basel III Endgame, or B3E, and new Federal Reserve rules regarding something called AOCI. Can we translate this regulatory jargon?
Absolutely. The Basel III Endgame is essentially a sweeping update to regulations designed to force banks to hold more capital and become even safer. One of the specific proposed rules from the FED involves AOCI, which stands for Accumulated Other Comprehensive Income.
Let's translate that. AOCI is essentially the unrealized paper losses on government bonds the bank bought years ago at lower interest rates, right?
Yes, exactly.
When current interest rates go up, the market value of those older, lower interest bonds goes down on paper, even if the bank plans to hold them to maturity and never actually sell them.
Exactly. Historically, banks of this size were not forced to count those unrealized paper losses against their regulatory capital requirements. The new proposed rules would force them to include those losses in their regulatory capital calculations.
Which naturally sounds like it would severely hurt their capital ratios.
It would, if that rule existed in a vacuum. Currently, their adjusted CET1 ratio, that's Common Equity Tier 1, the gold standard metric for bank safety, they prefer to manage that ratio in an operating range of 9.25 to 9.75%.
Okay, so they're in a good spot right now, but the proposed regulations would change the math.
Yes, but here is the counterintuitive part. The same proposed regulatory changes also adjust how banks are required to calculate the risk weight of their assets. Regions actually expects these specific rule changes to reduce their risk-weighted assets by about 10%.
Wait, walk me through how changing a risk weight mathematically increases their capital. How does that formula actually work?
Think of it this way. Imagine the bank lends $100 to the U.S. government and $100 to a highly volatile startup. Regulators do not treat those two loans equally. They assign a heavier weight to the risky startup loan, which legally forces the bank to hold more emergency cash against it. What Basel III is doing is changing the formula on that scale. Because Regions Bank's specific mix of assets gets a more favorable weight under the new math, their total pool of risk-weighted assets physically shrinks by 10% in the calculation.
Oh, I get it. So because the denominator in their capital ratio equation gets smaller, their actual capital percentage goes up.
Exactly. Mechanically, that effectively increases their capital levels by about 100 basis points once fully implemented. The regulation designed to tighten the industry actually creates a mathematical buffer that further cements their stability. They are managing their adjusted CET1 ratio right in that target operating range we talked about.
So synthesizing this entire journey for you listening at home, we started by looking for a pulse check on the everyday economy. And by dissecting Regions Bank's Q1 2026 earnings, the picture we get is one of remarkable stability.
Very stable.
They are navigating 2026 by actively lending safely to proven corporate clients. They are tightly managing their deposit costs while benefiting from a massive base of zero-interest accounts. They are setting all-time records in treasury management because businesses are desperate for operational efficiency, and they are sitting on a massive pile of liquidity while their actual credit quality improves.
It is the exact definition of consistent, sustainable long-term performance, validating the exact claim they made on slide 1.
But as we wrap up, there is one final provocative detail buried near the very end of this dense financial report that points to an entirely different future.
Yes, this stood out significantly to me. We just spent all this time analyzing traditional branch metrics, deposits, commercial loans, checking accounts, all the physical infrastructure. But the report quietly highlights a massive ongoing metric: growth in digital mobile banking logins.
Millions and millions of daily logins, people managing their entire financial lives, applying for loans, and moving capital without ever stepping foot inside a physical bank branch.
Which raises a profoundly important question for you, the listener, to ponder as we leave. In a world where your primary and perhaps only relationship with your bank is a glowing 6-inch screen in your pocket, what does the term regional bank even mean anymore?
It's a brilliant point. Regions Bank has deep physical roots in the Southeast. That is their heritage and their historical footprint.
But if your liquidity is completely secure in the cloud, if complex algorithms handle the fraud detection instantly, and digital apps run the entire show from loan origination to treasury management, will geography matter at all to the banking customer of the future? It really challenges the very definition of a community institution in the 21st century.
If the screen works flawlessly, does it matter if the data server processing the transaction is in Birmingham, Alabama, or halfway across the globe? It is a fascinating tension between the physical reality of commercial lending and the entirely digital reality of the consumer experience. Well, thank you for joining us on this deep dive. We hope we cleared up some of those diagnostic muddy waters for you today. Just remember, true economic insight isn't always screaming at you from a breaking news banner. More often than not, it is hiding in plain sight, tucked away in the margins and basis points of a quarterly earnings deck, if you know how the mechanics work. Until next time.